You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Welcome back to another episode of The Builder's Mindset. And if you're paying attention to the emails and the posts, you know what time it is. It is earnings report summary time. Yes, I know we've heard lots and lots already, and because of some companies like Lennar and KB, because they close their year and quarter in November 30th, they start reporting very early in January. This may seem a little bit late. However, we did have a couple of public home builders who did not release their reports and do their calls until March 12th. So we were teed up, ready to go. We released it like right after that. We had Smith Douglas and United Homes that kind of were one of the last couple that got their numbers in. And we like to have them all done. We like to have them all in and all available before we put it out. And we were ready this time. So the only thing I regret is that I did not start this in Q1 of 2024 because I would have had a full year on the Qs. And the full year, which would have been nice. And I guess I could probably, in my spare time, I could go back and do Q1 and maybe we'll do that. I just had an idea. I think we'll try to figure out how to populate that. But if you're not on the list to get the report, reach out to us. We'll put the info in the show notes of how you can connect. Actually, we'll put a link in the show notes. So if you want to get the full report, this report that we share, we stack them for the year. So you'll get the Q2, the Q3, Q4, and the year end. And essentially what we do is we just go take all the public information. It's all public. It's all out there. They all release their financials as per the SEC. That's why it's for the public home builders, because they have to, the privates don't. And we just, we summarize it in a nice little spreadsheet form and then PDF it for you. We do a little section on each of those public builders, the good, the not so good, and the notables. Just, that way, if you don't have time to read the whole report or listen to the hour earnings call or the multiples of them, we do the work so that you get the information in one nice little spreadsheet. Sorry, my printer ran out of color, or doesn't have color. The black and white, but ours has a little bit of color. If you download it, it looks nice. I think what we're also gonna do, we're gonna do a free review in the next couple of weeks where we'll actually pull this up on screen. We'll go through it all. We're thinking about maybe doing it as a webinar so we can actually let people come in and ask questions in the chat and go through that. But with that said, we're going to dive in, just give you some high points, right? So this is a special one because it's the quarter four and year end for most of the builders. And what I mean by caveat on that is, so D.R. Horton, their fiscal year closes September 30th. KHAV, their fiscal year closes on October 31st. Beezer's also November 30th. And those are the ones that are really wonky. So when you look at, I think the only one that's on the quarter four that's not technically a quarter four is Horton, because that would be a full 3 months off. So theirs is really Q1. But in the full year, we did do their individual full years for their 2024. So the data is representative in that fashion. The thing that does, though, I would say get a little wonky is, the seasonality of home building. So some of the metrics can be a little off if you're looking at a full year of one versus the other, particularly right now, because what I would say is that Q4 of 2023, definitely from a margin perspective, felt a little bit more stable and solid than Q4 of 2024. So, if we're looking at, say, the full year of a D.R. Horton, I feel like their margins are going to feel a little bit better because it didn't include Q4 of 2024, which I feel like was a little weaker than last Q. So their Q1 was Q4 of last year, and so they don't have the Q4 of 2024, which you can clearly see, and I'll talk a little bit about that. I'm going to go over that as well, sort of the trending from Q2 to Q4. some of the margins, the gross margins, and what's kind of happening to builder gross margins as we've kind of gotten later in this world and season of incentive margins. But let's start with just a quick high-level overview. Despite the challenges, the economic challenges such as rising mortgage rates and affordability pressures, which are coming along with rising prices and those rising mortgage rates, 2024 was a record year of deliveries and revenue growth for many home builders. Companies continue to use those rate buydowns and incentives to sustain the demand and keep sales going, keep deliveries coming along. But that did lead to margin compressions. And if you've been getting the report since Q2, you saw that probably starting in Q3, and you're really seeing it now in Q4. And the builder stocks were getting penalized for it, and they continue to be penalized because, well, you know my thoughts on it. Lennar, Horton, NVR, Meritage, Taylor, KB, etc. told they're going to be around for 10 years. They've been around for multiple cycles. We're just kind of in a cycle and we're working through it. So I always find it interesting that Wall Street penalizes them when their long-term forecast and outlook is good. They're not going to like close up shop next week. So, but anyway, so the industry continues to focus on affordability and spec homes. Some are going away from, some are not quite as focused on spec homes. You'll see some like KB are working on the to-be-built type homes, made to order, built to order. Expanding community counts. Everybody's trying to expand community counts. I will probably do another podcast in the next few weeks. Been thinking about doing one. I was explaining to somebody how community counts are kind of relatable to like store counts. Like if you see like a Target or a Starbucks, community count. Sometimes you hear the term flag. But it's really a storefront for a home builder, and there's some challenges to those numbers, and it's kind of like a never-ending cycle of trying to maintain and expand that community count. So, that's been the focus, like really for home builders is, for the most part, most of them have been focusing on faster build times and spec homes, like quick move-in homes, affordability and how to combat that affordability through rate buydowns and cost reductions. And then expanding their community counts to continue to drive the volume, which once again, Wall Street demands higher volume, higher revenue, and sustained or improved margins. So we had just like total revenue industry-wide, we're seeing numbers of +5 to +12% across the public builder landscape. Homes delivered, this is year over year, 23 versus 24 for the revenue and for all these. Homes delivered increases of 7 to 15%, depending upon the builder. Lots of mergers and acquisitions, which helped that in some way. A lot of organic growth too, just really taking advantage and capitalizing on the markets. New orders up as well. Interesting though, I'll talk about that when we get really dig down into the Q4 of the trends that are shifting. The tides are shifting there. Gross margins. The gross margins for builders. I mean, we're talking in the range of 21 to 28% year over year, and we'll talk about that a little bit detail more. Kind of flat to down 2 percentage points or 200 bips. And I'm not going to joke around about the bips. Why can't they just say 2 points? I don't know. We've talked about this before, but anyway, and crazy stock buybacks. Really, builders had a lot of cash, a lot of free cash, so lots and lots of stock buybacks, and all kinds of. It was just a good year. 2024 was a really good, solid year for home builders. There are signs of like a little bit of weakness in the overall market as we really a little weak in the Q3, and then really sustained weakness as we saw in Q4. But nothing that I don't think the builders will work through and work around. We had industry-wide annual revenue and delivery growth, led by Lennar, Horton, Meritage, MI, Pulte. They were all showing sign like 10% year-over-year growth in closings. We had, strong profitability reported by TriPoint, Taylor, Toll, NVR, and, all that despite gross margins do remain under pressure. And as we said, primarily due to higher incentives, mortgage rate buydowns, and, but they've managed to use spec homes and quick closings and cost control measures to help stabilize profitability. I wouldn't say profitability, it's not up for sure, but it's not cratering. And so we'll talk about that a little bit. We'll do some Q2 to Q4 margin review, and let's kind of dive into that right now. The Q2 Q4 margin review. I'm going to pull this up over here. See where I put that. We had, did I print that? So the Q2 to Q4 margin review was definitely under pressure this year. And we'll review that and kind of show you who was flat and who was down. And there was, I'd say, one kind of surprise. There was a surprise of one actually moved up. There we go. So let's see. So from Q2 to Q4, as I said, my only regret of the whole thing was that I did not start this in Q1, but I was kind of detained with other things at that point. Maybe we'll go back and do it. But Q2 to Q4, we're just looking at the gross margin in Q4 versus Q2. Lennar, NVR were flat, literally flat, 0-0, like no movement. A little bit of movement in Q3, but like Q4 solid, right on par with Q2. Let's see, and then on the lowers, we had KB Home and Toll Brothers were down 0.3% from Q2 to Q4, and Century Communities, MI, and DR Horton were down 1.3%, just over 1 percentage point. And Meritage and PulteGroup were the big kind of drops. I would say, Meritage really plays in that real entry-level market, so they've got some things they've really got to do to keep things, moving. I only did the top 10. Next year I'll do all of them, but Meritage Homes gross margin from Q2 to Q4 was down 2.7%. PulteGroup was down 2.4%. And then the surprise, Taylor Morrison, their gross margin was up 1% from Q2 to Q4. And so we can talk a little about when we get into the review of their actual numbers, but just a little surprise there. I think that shows that there can be some pricing power depending upon what market you're in. And, Taylor Morrison, I think, has a little bit better mix as it relates to a combination of sort of entry level or kind of like entry level plus and first move up and second move up, and then they still got their toe or big foot, I would say, in the active adult. So they're kind of probably got a little bit more breadth, not too much depth in one given area, that I think has probably helped them sort of weather that storm and improve their margins a bit. And solid margins at that. Their gross margins at Q4 were 24.9, kind of, I would say, solidly in the, I'd call front of the mid pack when it comes to the public home builders in terms of their gross margin. So, all right. And then, so as we talked about, lots and lots of buybacks, big buybacks, free cash flow. Lennar, the big one, $2.1 billion in buybacks. Horton, $1.1 billion. Pulte, $1.2. NVR, $2. And the list goes on. But a lot of buybacks this year, and just all in all, just a solid year end results. Record home closings and revenues. It was just a good year, and this is what gives me, even with the margin pressure and some of the regional volatility challenges that remain. We've heard a lot about a little bit of extra overbuilding maybe in Texas, maybe a little bit of overbuilding in Florida, and lot of hubbub right now going around about, say, the mountain regions, say Denver and Utah kind of softening a little bit. But I still feel with the overall strength in the market that we saw in 2024, the numbers that were posted, even going in through Q4, that there is a lot of potential, as I've said, and I've said this before. I believe 2025 is going to be kind of flat and on par with 2024. I think this is the year that builders should make the most of the not growing, and they should recalibrate. They should assess their leadership team, their rank and file team, their product development process, their purchasing process, their construction and scheduling process. They should review all of that and put a strategic plan in place to really capitalize it. And look, we're almost done with the whole quarter, and we'll talk about quarter end in a little bit here, not on this podcast, but on another one. But there's no time to waste. The 2026, if it's going to be what it looks like it's going to be, you better start now in Q2. Make a concerted effort in Q2 and Q3. In Q2, assess and establish the plan. And in Q3, start implementing that plan. So in Q4, you can do some final, put the bow on it and get ready for 2026. And don't forget, if 2026 is going to be what we think it is, the 2026 starts July 1st, 2025. The starts in July are what make 2026. So I feel from a closings and a revenue perspective, 2025 is going to look a lot like 2024. And with that, let's dive into, I want to go over 2024's Q4 first. I want to dive into that first, and then we'll look at the full year, and we'll kind of talk about that after we get to that, after we get through Q1. So let's see if there's okay. All right, so we get ready there. So Q4, like we said, just we were seeing the margins start to come down as we talked about. The Hortons and Lennar was flat, Horton was down. Lennar had a miss in their Q4 sales. They talked about that on their call. Their stock got hammered because of it, and they basically said that they did not react fast enough to the market changing with localized community level pricing adjustments combined with localized community level incentives to keep the pace going. So their sales pace dropped a little bit behind their starts pace, and so that got them off a little bit. But still, all in all, the numbers were not bad. Lennar still had an absorption of 4.2 sales per community per month in Q4, which is really, really impressive. They led the queue, whereas most of the other builders, and if you look at the report, you'll see there's a few builders that I struggled to get the information of. Not every builder reports absorption, and you hear me use that a lot. And I'm a big advocate of that as a health of the industry. I've talked about this before. 3 is the salt line. Below 3 but above 2 is acceptable and manageable. Let me call it manageable. 3 is acceptable. 4 is like solid. That's really, you really want to be at 4. For me, I like to see 1 sale per community per week, which really averages out to about 4.3 per month. And so if you look at the ones I can get the data from, there's a handful that I can't. But Lennar led that group at 4.2, followed closely by Meritage at 3.9. Then we had KB at 3.5 and KHOV at 3.4. And then the balance were in the 2s with kind of, Beazer was down in the 1.9, just under 2 range, and LGI at 2.3. So, the market for Q4 is kind of getting into what we say. I said, like, 2 is acceptable, 3 is okay, 4 is really, 3 is good. 4 is really where we want to be. So most builders are still above the acceptable line. They're figuring out recalibrating and figuring what they're going to have to do going forward. And so we'll talk about this in another podcast, but I think you're going to see a lot of push for price reductions, which will be interesting to see how that goes, because I think we also have a lot of tariff talk, price increase costs. So there's some clashing, I think, going to be going on from suppliers and trades wanting costs to go up, builders and wanting costs to come down. So we'll see how that all plays out. So, but anyway, so here's one of the biggest pieces, I think, and I want to go back to last year's Q4. I haven't had a chance to yet, but net closings and revenue, Lennar, number 2 home builder by closings in the nation, number 1 in closings for Q4, number one in net revenue, 22,206 closings in Q4 with 9.9 billion in revenue, ahead of D.R. Horton, the official number one home builder in the country by closings, at 19,059. So Lennar had them by a good 3,150, and Horton with 7.6 billion in revenue also had them by 2.3 billion in revenue for the Q. So really, really interesting that Lennar took the closings and the revenue for the quarter. And then for gross margin for the quarter, Green Brick, who some of you may know, I believe they're out of Plano, Texas, I think is where their home office is. Kind of a growing builder, 1,019 closings for the quarter. They're at 3,783 for the full year. Gross margins of 34.3%. They also took the net income percent of 18.3% crown, and really impressive what that group is doing. Just a really solid, well-run builder. With a solid average sales pace of 557, not the highest, not the lowest. So, okay, net income. So net income, pre-tax income, Lennar takes it there. No surprise there. Now we're back into out of the percents. Once you kind of get out of the percents, you're up in the top. Top two are going to be fighting it out for that all the time at 1.4 billion, 1.45 billion, with the number two was Pulte at 1.182. Yes, Pulte, number two, and Horton was number three. So kind of a little bit of an interesting one there, like with Lennar having a strong fourth quarter. Once again, this is, I say, is interesting. They got hammered by the street because they missed their sales number. But when you look at their closings, their revenue, and their net income and their absorption, they're number one in Q4. So it'll be interesting to see if this changing market tends to benefit Lennar. And I believe I've said this in the past. I believe by 2030, Lennar takes Horton in closings on a yearly basis. All right. So there we are. SG&A, sales, general, administrative expenses. Yet again, as always, I don't know exactly how they do it, how they measure it. Pulte coming in 4.2%. Lowest SG&A for Q4. Close second was NVR at 5.6. Those two are always the kind of the leaders in that industry. We've talked about this before. For me here, 10% is the salt line. Builders work very hard to try to get to 10 or less. 12 is good. 12 is really, really good. I'm not going to dog anybody under 12, but when you get under 10, man, builders are really, really happy about being under 10. And so under 10, you've got Horton, Lennar. We already mentioned Pulte and NVR. You've got KB, you've got Taylor, you've got Toll Brothers, Dream Finders, KHAV, and that rounds out the ones that are in the under 10% range. In the 10 to 12, you've got Meritage, Century, MI Homes, TriPoint, Green Brick, and that rounds out the 10 to 12. And then you've got the other ones who are, you got your LGI and Beazer, Smith Douglas, Landsea, and United Homes Group over the 12%. So that's kind of where the SG&A shakes up. And average sales price, we won't belabor this too much. We all know top average sales price almost always, I don't see this ever changing, is Toll. Q4 was just over $1 million, not quite 1.1 average sale price, and taking the price for lowest because I think there's value in this. I do. I don't think this is a bad thing. United Homes Group's at $324,000. Some of the other notables I would say down in the lower end, which I'm a big fan of, like affordable, is Smith Douglas and LGI as usual. They're always down there at the bottom. Century Communities, Meritage Homes, those and D.R. Horton. Those round out the ones who are keeping it below $400,000 on average across the country. And and then trying to think of what are the other notables. Taylor Morrison was just over $600,000, which I think kind of helped probably their profit margins, the way they manage their pricing really, really well to get those margins where they were. Net sales, the winner for net sales was D.R. Horton. They took this one category, which was interesting because this is where I continue to be confident in my prediction that by 2030, Lennar is going to get them. They were 17,837 homes sales for the quarter, whereas Lennar was only behind them. They were 16,895, so just about 1,000 behind. So now you think about this. When we go to their year, if you're 1,000 to 2,000 a quarter behind, you're looking at 4,000 to 8,000. Lennar and Horton's got to have a bigger spread than that, in my opinion. If they're going to stay only beating Lennar in sales by 1,000 to 2,000 a quarter, that's what's going to get Lennar to continue to inch up, continue to chip away at that lead that Horton has, and to take them over. And I think, like I said, by 2030, I believe Lennar and the machine are going to make that happen. And some other notables that we talked about, though, it's a tale of two, right? It's Lennar and Horton. They're the top two, and then you drop down, and Pulte, who's number 3, 6,100. So let's put that in perspective. Lennar, they missed their number because, as they said, they didn't get their pricing strategy fast enough down to the community level. So I would say that 16,895 is understated to what it should have been, but let's just call it that, 17,000. And Pulte at number 3 at 6167. So that kind of tells you that's like almost a third, right? So the number 3 builder is almost a third the size of number 2, and then they start to trail off there. So the big guys just keep getting bigger and bigger, and it'll be interesting to see what happens over the next couple of years as the market kind of reshapes itself. We'll be watching that. We'll keep you posted on that. All right. Next one, we track cancellation rates. So cancellation rates, the best would be the lowest cancellation rates in the industry for Q4 was Toll, 2.5%. They tend to be pretty strong in this area. They were really strong this quarter, as they usually are. And then the highest, they're always typically the highest, but it was pretty high. This time is LGI. They really cater. I would say LGI caters to a true first-time home buyer. I mean, I am talking not really like just the first-time buyer. A lot of their buyers, I think, wouldn't even have thought of buying a home before they got outreach from LGI. So they meet a critical need in the marketplace, in my opinion, but 28%, you're gonna see that. They've got low credit score buyers, low cash buyers. They're dealing with that. It's part of their business plan. And it probably plays into their SGA, which is one of the highest ones, because that selling and general administrative expenses is going to be higher the higher your cancellation rate is. So some of the other notables I would say, if we talk about solid ones, is Green Brick, 7.8%. That's a solid number. Pulte Group, 10.4%, solid number. Cancellation rates on average are up a little bit. That's to be expected with higher interest rates. People are like trying to qualify for what they thought they could get, and then things just aren't working out because of the higher interest rates. So it's kind of what happens. It'll be interesting. Like you said, we'll have to watch what happens with interest rates and see what builders do to navigate that. But next, one of my favorites, you guys know this, closings per employee annualized. So I had somebody question this when I put out the Q2 one. I want to be really clear. I annualize this number, even though it's Q data. So essentially what we do is we take the closings in the quarter, we divide it by the total number of employees as reported, through their information that I can get through either Google Finance or Reuters Finance, etc. And then we multiply it by 4, so it's annualized. And the winner there, who's been the winner for, I would say, a few quarters, I think every quarter this year, Meritage Homes, 8.8 closings per annualized employee. Why do I like this one? I like this one a lot because I think if you're a smaller builder, whether you're public or private, this one and the next one that I just added this quarter is something to kind of give you sort of a bearing. If you look at, let's say, gross margins, SG&A, cancellation rate, closings per annualized employee, those are the metrics, in my opinion, that you can look at no matter the size of builder you are, and you can kind of strive for that. If you have 500 closings, is your SG&A going to be higher than a builder with 5,000? Probably, but it doesn't mean you can't aspire to try to manage your business into that. If you're building 500 homes, is your margin going to be lower than someone with the leverage of 5,000 or 10,000 or 50? Probably, but it gives you something to aspire to and something to understand what can be achieved with scale. Closings per employee annualized, it's the same thing, but I do believe If you're into the 500 or more, you can look to this as a benchmark for what you do and how you do it. And why do I say that? So Meritage Homes, been the leader for a while at this, 8.8 closings per employee, as reported on the site. Why do I say this is something that you can look to as a guide? Is because if you look at, say, a Beazer Homes with 3.1 closings per employee annualized, and then you also look at a Pulte, 3.92, not really that far off. Pulte did 8,100 homes in Q4. Beazer did 907. So I really think that's something that you can aspire to in terms of, even looking at the big guys. And so you look at the publics. Here's what I said, and this is what my organization does. We help smaller privates, production builders, doing between, let's call it 100 homes or even 50 homes up to 1,000 and more, but that's really the sweet spot, really, or even 50 to 500. We help you adjust your processes, implement product development and other schedules and systems and analyses so that you can think more, act more like a big public home builder to achieve some movement towards these metrics, to get some significant or marginal improvement in these areas. So anyway, is everybody going to get 8.8? No, absolutely not. Who's number two? I just realized I made a mistake. Pulte was number two. Smith Douglas came in at 9.01. Okay, so 9.0. So there we go. This really tells my story. Smith Douglas closed 836 homes with a reported 371 employees. So if that number is correct, they had 9.01 closings per employee, with Meritage coming in at 8.01. So it can be done. It's about how efficient you run your business. This is what we also help folks do, and get to that place where they can close more homes with fewer employees without. It's all about making it easy, not about making it hard. So you can get to that place. There are ways to move in that direction, and that helps the bottom line. And that translates to lower SG&A and higher margins. And as Smith Douglas' gross margin was 25.5%, very respectable, very, very respectable number. All right, and so what we've added this quarter now too is revenue per employee annualized. So it's a similar number, right? It's the same kind of thing, is as you look at that. And so let me make sure I didn't make the same mistake twice there. So I did not. Okay, so number one here actually this quarter was Dreamfinders Homes, $3.558 million of revenue per employee. They were also pretty high up on the employee. They had 7.1 closings per employee, so they're kind of right in there. And then number two, no surprise, was Meritage Homes at 3.482, and Smith Douglas, who had the most closings per employee, solid, respectable 3.1 million. Now, what's the sweet spot? You can look at the report, and what I will tell you is I would aspire to be over 1.5 million. The lowest on the public's reporting was 1.6 million, and that was Beazer Homes. You also had 1.7 was NVR Homes, and NVR is an industry model. I don't know if this has anything to do with why they have so many employees relative to revenue, but they buy a lot of things, bits and pieces. They do a lot of itemized purchasing, lumber, sticks, plumbing, faucets, fixtures, and all that. And that, I think that takes a little bit of employee, but I could be wrong there. But look at this as a guideline. This is a real guideline. That's your picture for 2024 Q4. Now we're going to dive right in, and we're going to go into the full year. We'll do the highlights of the full year, and then we're going to also talk a little bit about the numbers that I'm seeing for the changes in closings and we'll finish off with that, closings from 23 closings to 24 closings, okay? So 2024 full year net closings. Remember what I said, Horton's numbers, their year is shifted. So this is from September 30th, 2023 to September 30th, 2024, because of where their fiscal year closes. Lennar is November 30th, 2023 to November 30th, 2024, as is KB. And then Toll, and Beezer's also the same as Horton, September. So it shifts a little bit. And as I said, what normally that isn't a big impact, but I would like to just make sure I remind everybody again, Q4 was a little softer this year than last year. So I feel like some of those builders who closed their year off the calendar year have a little bit of a benefit over the ones who closed theirs on the calendar year. So, but we are where we are, and so we're going to do number one in closings. Horton, as we talked about, they are America's home builder. Number one, 93,660 closings compared to Lennar's 80,210. But here's the interesting take. They're also number one in revenue at $36.8 billion, with Lennar a close $35.4 billion, $1.2 billion off of them, $1.4 billion off behind them. And I think, as we said, that has to go with the average sales price. D.R. Horton's average sales price was $378. Lennar's was $423. So that's kind of the telltale sign from there. But once again, back to the tale of the two bigs. For the year, Horton, 93,660. Lennar, 82,10. Fair amount of gap there. I still think Lennar closes that gap in the next 5 years, but then we go to PulteGroup, and now we're at 31,219. So a little bit more than a third, but definitely a significant drop off. Then we go to 22,836 for NVR, and then we drop down to 15,611 for Meritage. But Meritage, solid for Meritage, 15,611. KB Homes breaking 14,000, 14,169. And then Taylor Morrison at 12,896, almost hitting that 13,000 number. And then there's going to be a little bit of movement when the Builder 100 comes out. I know everybody loves to get that from Builder Magazine. There's going to be some movement, as in Toll got 10,231, and Century closed it out with 11,007. So looks like they're gonna move up a notch in terms of closings, and see if anybody else is going to move. Yeah, a little bit further down, looking like KHOV might jump over LGI. Looks like TriPoint's going to jump over both of them. So going to be there'll be some movement, let's say, in the top 20, 2024 versus 2023. And then, interesting, when we go to revenue, we're probably going to see some moves in terms of revenue. Taylor Morrison, with that strong margin and strong selling price point, I believe they're going to go, they're number 7 on closings. I think they're going to hit number 6 when it comes to, number 6 when it comes to revenue, right behind NVR, and it looks like Toll is going to get the number 4 spot for revenue this year, but we'll wait for the official numbers to come out. Gross margin, Green Brick, we talked about them. They had solid fourth quarter at 34.3. Their year ended up at 33.8. So really, really solid year for them. Net income, again, D.R. Horton up at the top. Just that number of closings, that volume has got them, at $6.285 billion. And net income after tax, Green Brick, a solid 18.2%. Just really, really strong numbers. And then, if we want to round out all those builders who managed to get a net income of above, we said 12%. It's kind of like the salt line. Horton 14%, Lennar 11.1%, Pulte 17.2%, NVR 16.3%, Meritage 12.4%, Toll 14.9%, MI Homes 12.9%, and Smith Douglas coming in right at 12%. So, look, as you think about these things, I want to point out, and I'll do this, I think maybe in the webinar, builders have to fund the land pipeline, and that takes a lot of money. So a lot of this capital that they generate allows them to go out to the market and put that into new land to open up new communities, which they need to do to keep growing and keep building houses. So SG&A for the year 2024. Let's see, we had up at the top looking like NVR was 5.8%, was the lowest of the year, And the highest is looking like that was LGI Homes at 14.6, as we talked about. Not unexpected with the style and the model of business plan they have. Average sales price, top of the charts was Toll Brothers at $985 for the whole year, and coming in at the most affordable, maybe. Let's see, it really depends on the market you consider. But United Homes Group at $324 for the average sales price for the year. Net sales. So this is an interesting one. D.R. Horton again at 86,000, and Lennar right behind them at 76,000. So there's a little less than a $10,000 variance in the net sales, but a $13,000 delta in the closings. And what's interesting, as I said, I believe Horton gets the benefit because of the slide, because their year ends September 30th. They didn't have Q4 2024. So once again, I see that, I think that spread should be wider. I think D.R. Horton should have more sales because of the shift in where their fiscal year ends. I also think they need to have more closing or more sales than that to keep that number one spot in terms of volume of closings. And all right, and then we'll cap it out with closings per employee for the entire year. I did not get this one wrong on the report. We'll make the updates to the report. The numbers are right, but which one I highlighted was a little off. But Smith Douglas did not get the whole year. That one does go to Meritage, 8.49 closings per employee per year. They also took the revenue at 3.45 closings $3.545 million of revenue per employee. And let's see if there was any notable runner-ups. I would say Smith Douglas was a solid runner-up in terms of they had 7.73 closings per employee with 2.6 million in revenue. On the revenue side, I would say the one trailing right there is Green Brick at 3.2. So, like I said, the bigger you are, the easier it is to achieve some of these metrics, but that doesn't mean they shouldn't be used as numbers for you to aspire to. I mean, that's really what this all boils down to, is when you get to see this public data and this public information, it helps you understand what's achievable at scale. And with that, we're going to wrap up with a little bit of a quick summary. This is the longest episode I've ever done, and I apologize, but it's my favorite one. I love doing the earnings report. It's my favorite. If you want your copy, we'll put the link in the show notes. We'll also have the link. We'll do some posts when we post this out to let everybody know this episode is dropped. If you see it, it'll be in there to get your copy so you can follow along. And but let's wrap up the episode with the 24 closings versus 23 closings. So D.R. Horton with their 93,660, they had 2,883 closings more in 24 than 23. 3.1% increase, a little on the lower end of things. And here's what I was talking about, where I believe that Lennar is coming for them. Lennar, they're 80,210 closings compared to the 73,087 in 2023. They increased their closings by 7,123, 9.75%. They keep doing that. I would have to be even better at math than I am to figure out what that is, but my gut is telling me by 2030, they get there and they take the number one spot for closings. So, and now we'll just kind of round it out. I'll go through the percentages down the list. So Pulte, up 2,600 closings, 9.1%. NVR, up 2,100 closings, 10.52%. Meritage Homes, they're up 1,635 or 11.7%. KB up 933 or 7.05. Taylor was up 1401, 12.19% increase in closings, 24 over 23. Toll, 6.8%. Century Communities was up 15% year over year in closings. 1,439 more than 2023 for a total of 11,007 homes. I bet they fought pretty hard to get to that 11. That's a big milestone. Congrats to the team at Century for that. MI Homes up 11.62%. Dream Finders, here's the big one. They had a couple of acquisitions. We talk about that in the notables in the report that you can read, but 1,269 closings more, 17.35%. And then we get some of the tough ones. LGI was actually down 700 closings, down 10.42%. KHAV down 125, down 2.28%. TriPoint, 1,186 increase, closings 22.49%. Beezer's up 4.8%. Green Brick up 21.13% with additional 660 closings. Smith Douglas, they're up 20.82%, 494. AMH, we don't go too much into the details of the numbers of AMH because they do for rent, everything's for rent, so their metrics don't line up as well and as easy. But I did think I would note their completions. Their completions were up 1.68% or 39 homes. Land C, their closings were up 708 or 33.35%. I'm not sure how much that might have had something to do. I know they got a great division running there in Colorado. Lisa Wiebelhaus and they picked up Richfield Homes. I want to say that was last year, if that was late 23. But I'm sure that helped them. And then we got United Homes Group. They were up 48 or 3.47%. So, all in all, except for a couple little spots, everybody's up. Everybody's having a solid 2024. That's why I said I predict kind of flat for 25. I'm not a pessimist. I think here's the silver lining. When you look at the pressure in when you look at the pressure in Q3 and Q4, and you figure that the builders, for some time now, have figured out how to sell with the interest rates they have, how to balance margins. I think margins stay stable. They're kind of flat to down. I do agree with that. Taylor was up. Kudos to them. That was a great job by that team over there. But they are generally flat to down. Lots of increase in closings in 24 over 23. Don't think you're going to see the same for two reasons. One, they don't really have the community count. If you look at Southern California in particular, I watch that on a weekly basis. They do not have the same number of communities right now as they did a year ago. They're going to be struggling from a community count perspective. They've got the sales aspect to kind of balance. I'm looking for 2025 to be flat by all metrics. We'll call it, I'm going to say, I'd put money down plus or minus 5%. I know that's a big hedge bet. I'd put a significant amount of money down plus or minus 2.5% is what we're going to see 2025. Closings, revenue, margin, everything, plus or minus 2.5%. And a lot of the metrics I think will be plus or minus 1%. And so 2026, whole different ballgame. New communities opening up. And with a reasonably stable market, which I think we have, 2026 will be a good one because they'll have more options for more stores. Okay? So that's what we got. If you don't have the report, you should get it. We'll make sure we advertise that you should get it. It's free. When you get it, you order it, you'll get Q2, Q3, Q4, and the full year. Lots of information. We highly encourage that you go and you get it so you can take a look at it, read along, and we hope you enjoyed this episode. This was probably your commute to and home. Unless you're in Southern California, then it was just your commute to, and I'm sorry. Have an amazing day. We appreciate your support. We appreciate you subscribing. Please like and subscribe because that helps push the podcast out to more people, helps that algorithm get it out there to folks who want to learn about home building. I like to think I do home building from an operational perspective, not a finance perspective, so it's a little more for everybody every day. I think home building is important to all of us. We all live in a home, whether you rent or you buy. It's all impacted by the housing industry, and I enjoy it. I enjoy doing it. I enjoy putting it out there, and I enjoy sharing it with all of you. So that's all we got. We'll see you next week. Have an amazing day. You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.